Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about Ford.
Yeah, Ford presents a really fascinating puzzle for investors as we're heading into the end of 2025, doesn't it?
It really does. I mean, on one hand, you have this, bedrock legacy value play. It's anchored by the incredible cash generation from its commercial arm, Ford Pro. But at the same time, it's a highly speculative restructuring story, right? It's just burdened by the huge capital drain of the Model E, the EV transition.
And the price action has been strange. It's been counterintuitive. It's sitting there rock solid in that 13 to 1340 range, and it even rallied, 2.5–3% in the face of some genuinely bad news. Supplier fires, tariff threats, none of it seemed to stick.
Exactly. And that brings us to our central question for today. Is this resilience, the stability we're seeing in Ford stock, is it being driven by, genuine underlying operational strength and real strategic discipline, or is this stability something else? Is it structurally engineered, maybe maintained by complex market microstructure and behavioral capital flows?
I'm firmly in the camp that the fundamental strength and the discipline management, they're finally being recognized by the big money, by the institutions, and that's what's establishing this firm, legitimate price floor. See, and I come at it from a completely different angle. I think we're looking at the symptoms, not the cause. For me, this price stability isn't about some new fundamental conviction. It's about the sophisticated structural constraints that define this stock's trading range. Ford is, it's famously range-bound, right? Stuck between $10 and $14 for what feels like forever. I think that ceiling and that floor are being manufactured by market mechanics, not just earnings reports.
Okay, so let me lay out my case. For me, the way I see it, this is all about management's discipline winning out, and the price action reflects institutional confidence in that. The market had every single reason to panic when the Novelis fire happened. That threatened the F-Series production, which is, it's Ford's entire profit engine.
Right, a huge deal.
A huge deal. And yet management was quick, they were decisive, and they affirmed their full year 2025 adjusted EBIT guidance of $6 to $6.5 billion. And crucially, the adjusted free cash flow of $2 to $3 billion. That better than feared outcome, that was direct confirmation of the strength of the Ford Pro segment. That thing generates nearly $2 billion in quarterly EBIT by itself. It's a cash engine that stabilizes the whole company.
Okay.
And then you've got to look at the strategic pivots, dissolving the Blue Oval SK joint venture to get full control of the Kentucky battery plant, and the capital-light Renault alliance for the small EVs. These are prudent, smart moves. They protect margins, they preserve free cash flow, and maybe most importantly, they protect the dividend. And this isn't new. This is a company that never did a reverse stock split, even in the 2008 crisis. That history matters.
I agree that solvency isn't the question here, but, history doesn't trade the stock today. And solvency just sets the floor. It doesn't create upside potential. My whole thesis is that the stock is structurally capped. And you can see it if you just look at the market microstructure, specifically the off-exchange trading data.
The short volume argument.
Yes, you have to look at what's facilitating all this volume. The data from FINRA consistently shows off-exchange short volume ratios for Ford bouncing between 40 and 53% of total traded volume. For anyone not watching this stuff daily, that is a massive number. It strongly suggests the liquidity we're seeing is being, let's call it manufactured, by professional desks. Market makers, high-frequency traders managing huge inventory positions. They're creating stability to trade inside a predictable range, not because they're making a big fundamental bet on a breakout above $15. And then you add the Theta Gang retail strategy on top of that, and you have a self-fulfilling resistance level. The 3.9 billion share float is just too big to move.
Okay, let's focus on that liquidity manufacturing idea, because I think that's where our views really diverge.
Absolutely. When 40 to 53% of the daily volume is happening off exchange, facilitated by these high short ratios then true price discovery is being obscured. It just is. The $13 price level becomes a function of institutional inventory management. The DMMs are just filling client orders and flattening their books. They are creating the environment, but it doesn't signal a real supply and demand imbalance that would lead to a real move up.
See, I understand that interpretation, and I agree that short volume is the crux of it. But I think interpreting that raw number, that 40 to 53%, as purely bearish is a huge misconception. In dark pools, high short volume often indicates the opposite. It indicates that there's robust buying demand that's being absorbed. The DMMs, they go short for a nanosecond to fulfill a buy order for a client before they locate and deliver the shares. It's a mechanism for accumulation.
Look at the data. The spike to 52.25% off-exchange short volume on December 5th. It correlates almost perfectly with the price stabilizing right after the Novelis fire news. So what does that tell you? It suggests that as retail was panic selling, institutional algos were in the dark pools aggressively absorbing that liquidity. They stabilized the price. It proves institutional accumulation right at that price floor. The smart money is defending $13 based on value.
That's an interesting point, though I would frame it differently. Okay, so maybe it stabilizes a momentary dip, but the reliance on these off-exchange venues, it just reinforces the structural cap on any real upward move. If the smart money had true directional conviction, why not execute on lit exchanges to move the price?
That's fair.
By doing it off-exchange, they hide the true demand, and it reinforces that sense of institutional manipulation that the retail folks always talk about. And look at the aggregate short interest, it's low, about 4.6%. So yeah, no mega squeeze is coming, but it also tells you there's no compelling bullish conviction to push this thing higher. They see it as a range-bound trading vehicle, not a growth story. The ceiling is firm.
Okay, let's shift to that retail aspect then. The behavioral side. The whole theta gang option strategy is fascinating, but could you maybe break down for our listeners how that specifically limits the price movement?
Absolutely. So when we talk about the theta gang, we're talking about thousands of retail investors who are systematically selling options contracts, covered calls, to collect the premium. The whole point is, by selling a covered call, you are explicitly betting against a huge upward move. You're saying, I don't believe Ford will go past $14 or $15, so I'll sell someone the right to buy my shares there, and I'll just pocket the premium.
Right.
This creates a self-fulfilling prophecy. When the stock starts to rally, those calls that were sold become a liability for the desks that bought them. So those desks have to hedge their exposure by selling the underlying stock. It creates a structural resistance, a cap that automatically kicks in and smothers any good news.
I'm not convinced that's a negative, though, because while it limits the speculative upside, it transforms the stock into a reliable yield vehicle, which is exactly what income-focused funds want. At $13, the 60-cent dividend is a 4.6% yield. That stability in yield profile makes it a bond proxy. It brings in a whole different class of buyer that provides a stable institutional floor.
But that's just the regular dividend. You haven't considered the special dividend expectations. The profitability of Ford Pro is so immense, it has fueled really strong rumors of another supplemental dividend in Q1 2026. This anticipation creates active buying pressure from income funds right now. They are buying ahead of the announcement to capture that extra yield. That's what's supporting the floor, not just retail cynicism.
That's a powerful short-term catalyst, I'll grant you that, but it's fighting against some very powerful long-term headwinds. So let's move to that third piece, the strategic pivots. I would argue that dissolving Blue Oval SK and the new Renault alliance, yes, they're necessary, but they are fundamentally reactive. They show weakness, not strength. Market sentiment on Model E is just terrible. Everyone sees the massive annual losses as this heavy anchor on the profitable parts of the business. And the Renault alliance, it's a purely defensive move. Ford is facing, double trouble in Europe. Their market share is shrinking, and they have this existential threat from cheap Chinese EVs. So being forced into a partnership just confirms that Ford is late to the race. Their own strategy wasn't working. This is triage, not some brilliant strategic leap.
E-platform to compete in Europe, that would cost tens of billions of dollars. It would absolutely destroy their free cash flow targets, and more importantly, they would have to suspend the dividend, and the stock would crash. Partnering with Renault accelerates their time to market, and it shields the balance sheet. The market today is not rewarding reckless growth, it's rewarding free cash flow protection. The fact that the stock rallied after the fire news proved that the market values that discipline above all else right now. They're shedding expensive projects to protect the core and protect the yield. That's the story.
But is that discipline sustainable? That's the core tension. Model E's still bleeding billions. And these capital-light responses, they're basically admissions that Ford can't solve its biggest problem internally, which is cost and scale in the EV transition. This structural bleed, plus the immense weight of that share float, makes it almost impossible for any good news, like the rare earth magnet license deal, to do more than create a little 2.2% bump before that structural resistance just slams it back down. The ceiling stays firm because investors are still cynical.
So to summarize my side, the stability we're seeing in Ford is fundamentally sound. It's supported by operational discipline, which we saw when they affirmed guidance. The Ford Pro division is a financial engine, and the strategic pivots are all about capital preservation and protecting that dividend. The high off-exchange volume, when you read it correctly, is institutional accumulation. The smart money sees Ford turning into a disciplined, hybrid yield vehicle, and it's worth this $13 valuation. The stability's real.
And my view, to wrap up, remains that the stability is engineered, and it's structurally capped. It's heavily influenced by the manufacturing of liquidity through that high off-exchange volume, which obscures price discovery, and by the self-imposed retail resistance from options harvesting. So while Ford's solvency is strong, it's a viable income play, absolutely. Significant long-term appreciation is just constrained by the weight of that massive float and the ongoing bleed from Model E. The price is as much about market mechanics as it is about earnings.
Absolutely. It's a profoundly complex thesis. An investor really has to weigh these market realities, the float, the liquidity, the behavioral caps, against the clear operational strengths of Ford Pro and the new capital-efficient direction. And, there's clearly more to explore here. We didn't even get into the fails to deliver spikes from late October and what they mean for options hedging.
Indeed. It's a fascinating battleground where old-school industrial adaptation meets really complex, modern market mechanics.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.